Saturday, March 16th, 2013. The island of Cyprus wakes up to news that will define financial history. Overnight, without warning, the government has agreed to freeze every bank account in the country. Not just accounts at troubled banks, every account, at every institution, across the entire island. The payment system has been shut down, ATMs have been emptied or capped, a national bank holiday has been declared, extended day by day while politicians negotiate behind closed doors in Brussels. When the banks finally reopen 12 days later, they reopen with capital controls attached. Cash withdrawals are limited to $300 per person per day. Transfers abroad are blocked. No one can move more than $5,000 in a single transaction without government approval. And depositors who held more than $100,000 in the two largest banks discover that up to 47.5% of everything above that threshold, money they had earned, saved, deposited legally, has simply been seized. Called a haircut, a euphemism for something that was, in plain language, confiscation. The Eurogroup president, when asked if this would become a template for future bank crises, said yes, and walked it back. Then, over the subsequent decade, the model was studied, cited, and quietly codified in resolution frameworks across the European Union, the United Kingdom, and the United States. Most people who heard about Cyprus in 2013 concluded that something like that could never happen in America. They believed the FDIC protects deposits, and the Federal Reserve is the lender of last resort. The American banking system seemed too big, too sophisticated, too well regulated to face such a crisis that forced a Eurozone member state to freeze its citizens' bank accounts. But here is what those people are not accounting for. The conditions that made Cyprus possible are not unique to small Mediterranean islands. A banking sector overexposed to bad assets, a government without fiscal capacity to bail it out, and a regulatory framework quietly prepared for depositor losses as a last resort. These are structural features, present in different forms and magnitudes in the American banking system right now, in 2026. This is not an argument that America is about to become Cyprus. It is a more precise and uncomfortable argument. The forces that stop banks from letting people freely access their money are not contained by geography or currency, nor by the assumed safety of the world's largest financial system. They are driven by universal mechanics of leverage, insolvency, and the terrifying speed of modern digital panic. And the structural vulnerabilities are measurably more present in 2026 than at any point since the mechanisms that protect your deposits were last truly tested. Let's go through exactly how a bank stops letting people withdraw money, where it has happened, why it happens, and what the current data says about the conditions that make it possible again. Most people who heard about Cyprus in 2013 concluded that something like that could never happen in America, that the FDIC protects deposits, that the Federal Reserve is the lender of last resort, that the American banking system is too big, too sophisticated, too well regulated to ever face such a crisis. A crisis that forced a Eurozone member state to freeze its citizens' bank accounts. Here's what those people are not accounting for. The conditions that made Cyprus possible. A banking sector dangerously overexposed to bad assets, a government without the fiscal capacity to bail it out, and a regulatory framework that had quietly prepared for depositor losses as a solution of last resort are not unique to small Mediterranean islands. They are structural features that, in different forms and different magnitudes, are present in the American banking system right now, in 2026. This is not an argument that America is about to become Cyprus. It is a more precise and more uncomfortable argument that the forces which produce the day banks stop letting people freely access their money are not contained by geography, currency, or the assumed safety of the world's largest financial system. That they are driven by universal mechanics of leverage, insolvency, and the terrifying speed of modern digital panic. And that the structural vulnerabilities which make such a day possible are measurably more present in 2026 than at any point since the mechanisms that protect your deposits were last truly tested. Let's go through exactly how a bank stops letting people withdraw money, where it has happened, why it happens, and what the current data says about the conditions that make it possible again. How a bank run actually works, and why it's become unstoppable. To understand why banks stop letting people withdraw money, you need to understand what a bank actually is. Not what it feels like, a safe, permanent institution, a vault where your money sits waiting for you. But what it structurally is, a bank takes your deposits and lends most of them out to home buyers, to businesses, to commercial real estate developers, to corporate borrowers. The bank keeps a fraction of deposits in reserve, enough to meet normal daily withdrawal demands. But it never holds enough cash to pay every depositor back simultaneously, by design. Legally, by the fundamental operating principle of fractional reserve banking that has governed every major financial institution since the 17th century. This works perfectly when depositors trust the bank, when they believe their money will be there when they need it. The entire system rests on that confidence, not on the actual physical presence of every dollar, on confidence. The moment that confidence breaks, the moment a sufficient number of depositors simultaneously decide they want their money back right now, the math collapses. The bank cannot pay everyone. It can pay the first ones, but not the last ones. Which means that in a true bank run, the rational thing for every individual depositor to do is to withdraw their money immediately, before everyone else does the same thing. The rational individual decision creates irrational collective destruction. This is the mechanism that has forced banks to stop letting people withdraw money throughout history. Not fraud, not mismanagement, though those can be catalysts. The fundamental structure of how banks work when confidence disappears. In the Great Depression, confidence disappeared slowly. The panics of 1930, 1931, and 1933 spread over 3 years through waves of regional failures. In October 1930, the Bank of the United States collapsed. $286 million in deposits, the largest bank failure in American history to that point. Then came 1931's dual shock. A cascade of Midwestern regional failures, followed in September by Britain's departure from the gold standard, which sent foreign investors converting their dollar holdings to gold and domestic depositors hoarding currency in fear of what came next. By early 1933, the banking system was on the verge of total collapse. Nevada declared a state bank holiday in October 1932. Michigan followed in February 1933. State after state shut its banks. On March 4, 1933, newly inaugurated President Roosevelt declared a national bank holiday. So the entire American banking system closed by executive order. Every bank in the country for 8 days. When banks reopened, only those declared solvent by Treasury examiners were allowed to reopen immediately. Of the 16,790 commercial banks operating before the holiday, fewer than 12,000 reopened in the first 3 days. Nearly 4,000 never reopened at all. Thousands of depositors received not their full savings, but partial payments, cents on the dollar, as the bank's assets were liquidated over months and years. The lesson policymakers drew from 1933, confidence, once lost, destroys the banking system faster than any underlying insolvency. The only cure, once a run begins, is to stop it by force, close the banks, freeze the accounts, buy time for examiners to determine which institutions can survive. Except that stopping withdrawals, though traumatic, is preferable to complete liquefaction of the financial system. The FDIC was created in 1934 specifically to prevent this from ever happening again. By ensuring deposits, the government removed the rational incentive to run. If your money is guaranteed, there's no advantage to being first out the door, no reason to panic. The insurance was the circuit breaker. For 89 years, it largely worked. Then March 2023 arrived, and something changed that the FDIC was never designed to handle. The 8-hour bank run, why everything is different now. Silicon Valley Bank did not fail because of fraud, nor was it poorly managed by historical standards. It failed due to interest rate risk mismanagement and a depositor base that was connected, sophisticated, and terrified. On March 8, 2023, SVB announced it sold $21 billion in bonds at a $1.8 billion loss to raise liquidity. This was meant to signal strength and proactive action, but instead, it signaled vulnerability. Within hours, prominent venture capital firms began withdrawing deposits and advising their portfolio companies to do the same. Information spread rapidly, not through traditional media, but via Twitter, Slack, LinkedIn, and encrypted chats. Within 8 hours on March 9, 2023, SVB received withdrawal requests of approximately $42 billion. This was nearly 25% of the bank's $166 billion in total deposits, drained in a single business day. For context, Washington Mutual failed in 2008, with $16.7 billion withdrawn over 10 days. SVB's depositors withdrew $42 billion in 8 hours. 2.5 times as much in 1/30th the time. Former FDIC Chairman Donald Powell, who ran a bank in the 1980s, watched SVB's collapse with disbelief. Bank runs used to be much slower, he said. Now, it's like a rocket ship. The speed mattered in a way that was not just impressive, but structurally catastrophic. SVBs could have posted bonds as collateral and borrowed liquidity from the Federal Reserve's discount window, but $42 billion left in 8 hours. The bank physically could not process the cash letter from the Federal Reserve. It ran out of ways to access liquidity before the standard safety valves could operate. The first Twitter-fueled bank run destroyed a $167 billion institution. Not in weeks, but in less than 48 hours. The FDIC did something only twice before. Invoked the systemic risk exception to guarantee every deposit. This included deposits above the $250,000 insurance limit, ensuring full coverage for all. 100% of SVB's uninsured deposits, representing 88% of total deposits, were made whole by government action. Why? Allowing uninsured depositors to face losses risked triggering immediate runs at other regional banks. The FDIC made depositors whole, not out of legal obligation, but to prevent panic from spreading. That decision solved the immediate crisis, but created a profound and unresolved problem. This problem now sits at the center of the 2026 banking risk equation, the $7 trillion bomb that nobody is talking about. Nearly $7 trillion in U.S. bank deposits currently exceed the FDIC's $250,000 insurance limit. $7 trillion sitting in accounts at American banks, above the threshold that the government has explicitly promised to protect. Held primarily by businesses, corporations, municipalities, wealthy individuals, nonprofit organizations, and institutional investors, all of whom watched SVB in 2023 and learned the same lesson. In a crisis, the first ones out get 100% of their money. The last ones out get whatever is left after the FDIC liquidates the bank's assets, which can take years, and which historically returns something between 50 cents and 90 cents per dollar, depending on the quality of the failed bank's loan book. The $7 trillion in uninsured deposits is not evenly distributed. It concentrates in specific types of institutions: banks serving commercial clients, banks with large corporate deposit relationships, regional banks with significant wealth management operations, banks that are, not coincidentally, also the most exposed to the commercial real estate crisis that is now fully active in 2026. Here is the specific vulnerability. According to Florida Atlantic University's Banking Initiative analysis of Q3 2025 Federal Call Report data, roughly 31% of all American banks, 1,374 institutions, are classified as CRE concentrated. These are institutions whose survival depends on the commercial real estate loans on their books retaining value. Loans that are now maturing into an environment where office vacancy rates are near 20%. CMBS office delinquency rates have exceeded 2008 crisis levels at 12.34%. And $936 billion in commercial real estate debt is scheduled to mature in 2026 alone. The FDIC's own Q4 2025 quarterly banking profile recorded 60 banks on the official problem bank list. Those with CAMEL's composite ratings of 4 or 5, indicating serious supervisory concerns. That number increased by 3 from the prior quarter. The official language calls this within the normal range for non-crisis periods. But this was before the full weight of the 2026 commercial real estate maturity wall arrived, before the February 2026 jobs report confirmed 3 months of job losses in 5, before the Iran conflict drove oil above $80 and pushed inflation expectations higher in a Fed that was already paralyzed. The question is not whether the 60 problem banks are individually significant. What happens to the $7 trillion in uninsured deposits when the first of those institutions fails? In a way that the FDIC does not immediately backstop. March 2023 proved this about the post-SVB world. The government's willingness to protect uninsured deposits is not automatic. It requires a specific determination by the Treasury Secretary, recommended by both the FDIC and the Federal Reserve, that failing to do so would cause serious adverse effects on the economy or financial stability. GAO analysis in January 2025 confirmed the systemic risk exception was invoked for SVB and Signature, because failure to do so would likely have caused further financial instability, while also noting that this protection can create moral hazard by reducing bank and depositor incentives to manage risk. In other words, the government may protect uninsured depositors, or it may decide that moral hazard requires it not to. The decision will be made in real time over a weekend under enormous pressure, with incomplete information about which banks are truly systemically important, and which can be allowed to fail with partial depositor losses. The $7 trillion in uninsured deposits doesn't run slowly. It doesn't give regulators time to deliberate. It moves at Twitter speed. At the speed that drained $42 billion from SVB in 8 hours. The mechanics of how it happens in 2026. Here is the specific sequence through which a bank in 2026 stops letting people withdraw their money. It begins with a stress event already underway. A regional bank reports elevated loan loss provisions from commercial real estate. Or a credit rating agency downgrades a bank's debt. Or news highlights a bank's high uninsured deposit and CRE concentration ratios. The analysis goes viral, not on traditional news, but on social media, chat groups, and private corporate treasurer threads. Within hours, corporate treasurers face the same calculation as SVB depositors did on March 9th, 2023. Their company holds $2 million. FDIC covers $250,000. The other $1.75 million is uninsured. If the bank fails, the uninsured portion enters a recovery process. It could take years, returning only cents on the dollar. The rational decision is to move the money now, before the news spreads and others make the same calculation. Digital banking makes this movement trivial. A few keystrokes, a wire transfer. This infrastructure makes the run unstoppable. No queue, no physical constraint, no slow tellers. Just electrons moving faster than any regulatory response. When withdrawal requests overwhelm liquidity, the institution faces 3 options. It can borrow from the Federal Reserve's discount window, if collateral and time allow, which SVB showed is not guaranteed. It can sell assets into a distressed market, crystallizing losses that may render the institution insolvent, or it can fail, triggering FDIC receivership. FDIC receivership means practically the following. The bank is closed, usually on a Friday, by design, giving regulators the weekend to find a buyer, or arrange a transfer of insured deposits to another institution. Depositors with accounts below $250,000 typically regain access to their funds on Monday morning. Depositors above $250,000 receive the insured portion quickly. The uninsured portion enters the receivership queue. That weekend, Friday evening to Monday morning, is the period when the bank has stopped letting people withdraw their money. It is brief if the resolution goes smoothly. It can extend if no buyer is found immediately, and it can cascade if the sight of one institution in FDIC receivership triggers the same recalculation. At every other institution where uninsured depositors are watching their screens on a Saturday morning, the FDIC, acutely aware of this cascade risk after 2023, has been updating its resolution planning frameworks, specifically to enable rapid, low-cost failed bank resolution, what it calls a weekend sale, moving assets to a new institution before markets open Monday. But this mechanism works when one institution fails at a time. It works less well when multiple institutions face stress simultaneously, and it does not prevent the period between the Friday closure and the Monday reopening, during which depositors cannot access their funds. What the FDIC actually holds and why it matters? Here is the number that contextualizes everything else. The FDIC's Deposit Insurance Fund, the pool of reserves maintained to pay insured depositors when banks fail, held approximately $125 billion as of mid-2025. That sounds like a large number. Against the $7 trillion in uninsured deposits, it is 1.8%. Against total insured deposits in the American banking system of approximately $9.5 trillion, it represents a reserve ratio of approximately 1.3%. The FDIC targets a reserve ratio of 1.35%, meaning the fund is operating at its floor. This is not a comfortable position from which to absorb a systemic crisis. The 2008 financial crisis pushed the FDIC's fund into negative territory, technically insolvent, requiring a credit line from the Treasury Department to continue operations. The fund was rebuilt through years of elevated bank premiums. It has never been rebuilt to the levels that would make a multi-institution crisis definitively containable without additional government intervention. This doesn't mean the FDIC fails. The U.S. Treasury Department stands behind it with the full faith and credit of the federal government. But a Treasury backstop requires congressional action in some scenarios, takes time in all scenarios, and does nothing for the depositor whose funds are frozen in a failed bank on a Saturday morning while the legislative and regulatory machinery assembles its response. The lesson history keeps teaching. History of banking crises produces the same observation, repeated across every century, every geography, across every regulatory regime in which it has occurred. Bank runs are self-fulfilling. The fear that a bank cannot pay is what creates the condition. That makes it true. Confidence, once lost, does not wait for facts. It moves at the speed of rumor, of social media, of encrypted messages, between connected communities of depositors who share the same rational imperative: get out first. The mechanisms that prevent bank runs: deposit insurance, lender of last resort facilities, resolution frameworks, systemic risk exceptions, are powerful but bounded. They work within defined parameters. They work when failures are isolated. They work when they can be deployed before confidence fully collapses. They do not guarantee that the day banks stop letting people withdraw money never comes. They guarantee that it comes less often, that when it comes, the damage is more contained, that when it comes, recovery is faster. They have never guaranteed it cannot come at all. In 1933, the guarantee failed for 8 days and permanently for 4,000 American banks. In 2013, the guarantee failed for 12 days in Cyprus and permanently for the uninsured portion of deposits in 2 institutions. In 2023, the guarantee held, but held only because regulators made an extraordinary discretionary decision to protect deposits. They were not legally required to protect, under a mechanism that explicitly creates the moral hazard they were simultaneously trying to avoid. The question that 2026 asks: given 60 banks on the FDIC's problem list, given $7 trillion in uninsured deposits, at institutions disproportionately exposed to a commercial real estate crisis already exceeding 2008 delinquency levels, given a digital banking infrastructure that allows a run to drain 25% of a bank's deposits in 8 hours, given a Federal Reserve paralyzed between inflation and recession, and a deposit insurance fund at its reserve ratio floor, is not whether the mechanisms that prevent bank runs are real. They are real. They have worked, more often than not, throughout modern financial history. The question is whether they will work next time, under conditions that are more stressed than at any point since they were last seriously tested, in a system that moves faster than the mechanisms were designed to contain, with a regulator that has already demonstrated the limits of its capacity and the discretionary nature of its most powerful tools. Less than 3 years ago, the day banks stopped letting people withdraw money is not an abstract historical curiosity. It is a documented feature of banking systems under specific conditions. Those conditions have appeared before. They are measurably closer to appearing again than at any point since the last time they appeared. That is not a prediction. It is a description of where the needle currently sits. The question: for every person with uninsured deposits, every business treasurer managing a corporate cash account, every individual relying on a bank's continued solvency for access to the funds their livelihood depends on, is whether they've looked at where the needle sits, or whether they're still assuming the mechanisms will hold. They might. They have, mostly before, but Cyprus also had deposit insurance.